So by way of intro, I'm Alex. I'm the co-founder of August. We're an on-chain prime broker, which means that we have a smart contract wallet and we lend against any sort of ERC20 or tokenized asset. Excited for the panel. So I think we can start with a quick round of intros, and it would be really helpful if you tell us what kind of assets you tokenize to begin with.
All right. Yeah, so hi, I'm Jake Timothy with Dinari, and we essentially tokenize stocks. So all equities and other ETFs or publicly traded assets that are liquid, that's what we tokenize.
Hi, pleasure to be here. My name is Sarahjon, and I'm a co-founder of ProfitR. We are tokenizing commercial real estate loans that are fully funded and have a very attractive loan to value. And for purchasers here who want to be early users when we launch next year, you will be able to, if you're a stablecoin holder, you'll be able to buy interest in these loans and receive attractive yield.
Hi, I'm Keerthi. I lead product for JP Morgan's digital assets platform. We tokenize a variety of different fixed income assets for the purposes of our clients using them as collateral. Digital bonds, the end-to-end life cycle around those bonds, and are expanding into private assets.
And I'm Itay. I'm the co-founder and CEO of TomNext. We don't actually tokenize anything, but what we do is distribute tokenized assets. So we really focus on alternative assets, particularly for high net worth, family office, wealth networks, really to try to solve the logjam in terms of getting digital assets and tokenized assets into the hands of real world investors.
So I guess there are many reasons to tokenize RWAs, ranging from reduced issuance costs, distribution, access, breaking geographical boundaries. Going back around, why are you tokenizing assets, and what does that enable beyond just regular purchasing?
Yeah, so for stocks, the first use case is access. So in other parts of the world, all around, including here in Argentina, if you have stablecoin, then you can start investing in stocks directly with us. That's a big use case we're using in collaboration with partners around the world. One thing I'm really excited about that's coming soon, though, is once we get a lot of these assets on chain, now we can leverage a lot of what DeFi has to offer. So really upgrading the financial markets and providing unique features, more efficient lending, for example, leverage trading. That's kind of where we're headed next, and that's enabling.
Is that permissionless, or how do you create secondary markets?
Yeah, that's
KYC?
a big challenge. That's a whole thing in itself. Yeah, we're doing that as a licensed activity, so that will be permissioned for sure, but then attempting to leverage and aggregate the liquidity.
And when you say you provide access, is the customer another institution, or is it directly to retail?
We do both. So we work with, like I mentioned, a lot of partners who are their own institutions, payroll providers, neobanks, and others. But you can come direct to us, KYC through our site, and we see a lot of crypto whales who want to diversify their crypto holdings into stocks, doing that as well.
Interesting. Sarahjon?
Yeah, why tokenizing? So what we're looking to solve is essentially a two-way liquidity or illiquidity problem where private markets, both on the debt and equity side, have grown tremendously in recent years. And similarly, individuals or family offices or what have you, it's hard to get access. And in these private assets, even if you are a large institution or family office that has done the primary investment, if you are looking to rebalance your portfolio or sell off a piece of something, you're usually going to be taking a big haircut. So what we're accomplishing with tokenization is a few things. Number one, enabling fractionalization and access to those who could not have access before. And then even within the institutional space, we're enabling seamless secondaries, trading within our regulated exchange, INX. So we are attempting to basically, both sides have a problem. It's that right now we're focusing on commercial real estate loans. Those who have originated, funded, and structured those loans are not able to sell or rebalance their portfolio without taking a haircut, and they would like to. And then on the other side, whether it's people who denominate their wealth in stable coins, or even people who are clients of wealth management platforms in LATAM, let's say. We're going to be selling through to your existing distribution network, to your wealth manager, and then they can sell it to you how they want, whether that's in tokenized form or within their app. But we're hoping to unlock some of the liquidity and solve problems for both sides there.
Just a follow-up question. So we have access, we have liquidity, but maybe a basic question, but why do we need to tokenize it, and how is that different from, let's say, a mortgage-backed security, which arguably retail can't trade, but you can, resell on a secondary market on traditional rails today?
Yeah, with private loans, I think we're going to be able to use tokenization to drive a lot more operational efficiencies. It essentially is zero incremental cost to add a new person, whereas the traditional sort of Web 2 fractional real estate or fractional alts platforms, they're still having trouble getting to profitability, and their minimums are often $10,000 or $20,000. We're able to, by doing KYC on chain and by enabling seamless secondaries, like secondaries in private assets in the traditional markets, have a lot of friction, like from an operational standpoint, from a legal standpoint, and then even from a pricing standpoint as well. You're usually selling something at 80 cents on the dollar in order to bring liquidity to a significant piece of one of your loans. So tokenization provides operational efficiencies as well.
All right, that's the third point. Operational efficiency, liquidity, access. What about Onyx?
Yeah, so definitely touching on the operational efficiency standpoint. I guess before I get into the why tokenization, just to, give everyone some context. So we have a digital assets platform. It is permissioned, has a variety of different use cases on it. And when we first approached the topic of tokenization, we very much saw it as a tool to addressing operational inefficiencies in the end-to-end life cycle of issuing, trading, and settling a variety of different assets. We, back in 2018, thought very deeply and structured a few proof of concepts around the bond market specifically, but realized very quickly that just by tokenizing something doesn't mean liquidity is there, even when you are of the magnitude of JP Morgan. So we then took a different sort of approach to tokenization, and it was very much how can we leverage this tool to allow our clients to do something with their assets that is operationally inefficient for them to do today. So for instance, in the first use case that we went live with, it was very much around how can you leverage tokenization to allow clients to access intraday liquidity. Take an asset, tokenize it, trade it for a matter of minutes or hours, and then unwind that trade and get back your collateral. And then the second use case was very much expanding upon that and thinking about the broad sort of world of collateral beyond just putting assets down for cash, thinking about, for instance, when you execute derivatives transactions, you need to place margin. There are certain types of assets that it's operationally cumbersome to use them to place margin. So if you can tokenize that asset, you now make it much more efficient to use that to place or pledge or transfer to your counterparty. So we're continuing to build out on that thread of utility, but in different forms. And I guess just to echo what you guys have said, we're now expanding into thinking about tokenizing private assets, specifically private funds, as a means of making them easier to access within other types of investment products, model portfolios, for instance, that can drive more capital towards that asset class in the event that they're more operationally efficient to invest into.
Got it. Okay. So Itay, you don't tokenize directly, so you need all these people to do their job first, and then, but why even distribute tokenized assets over a non-tokenized asset?
Okay, I like to keep it simple because we service accredited, qualified, elective professional investors, so wealthy investors. So they care about three things, fundamentally: save time, save money, make money, right? So the time consumption for alternative assets is horrific. right? It is literally the last analog asset class. If you think about equities are digital, right? Anything with the QSIP is digital. You can go on to Interactive Brokers today, type in the QSIP, type in the ISIN, you'll get a quote from 5 dealers on a corporate bond, right? So these folks are very comfortable investing digitally in all of the public markets, and then when it comes to private markets, basically the technology that is used to distribute them is golf, coffee, and tennis. Like, it's a ridiculous setup. These folks don't want to take the time to play golf with people. They don't want to take the time to talk to their private banker. I'm sorry, they hate their private banker. Ask them, 95% will tell you that their private banker is useless, right? So they want to be able to invest the same way, which is digitally. So ultimately, this is about digitization. Tokenization is a form of digitization, and alternative assets are very suitable for permissioning in a sort of tokenized ecosystem because, you know, public markets already have digital infrastructure, right? And so the first bit is save time, right? Then it's save money. So here's how, you know, if I invest in a private credit fund, what happens, right? They send me documents. It takes forever to read prospectuses, pitch decks, et cetera. Nobody actually reads the prospectus. But then you say, okay, I want to invest, and the person says, send me a wire to this escrow account, which I do. Then the money sits there for 2 months. They earn yield. I earn nothing. And then 2 months later, you get a subscription document back, right? So tokenization will allow for things like DVP, settlement for alternative assets, which will like improve what's known as yield drag. So saving money that way, right? Saving the operational costs of reconciliation, document retention, all these kinds of things, right? So save time, save money. And then make money is about finding great products. So rather than relying on a random person meeting me for a cup of coffee or asking me to play golf, usually they're selling terrible products, I can choose, because it's digitized, from a universe of digital products. And that's the aggregation that we do, and so that's the thesis. You know, everything is digital. People want access to every financial product digitally. If you're giving it to them in analog format, you are not satisfying them. So that's the thesis.
Can I add to that? I think, you know, I said access in the beginning. We also see increased efficiency in means of distribution. So closing the last mile from, yes, you know, I can log into Interactive Brokers and everything there, I find the number, I can buy and sell. By putting it on chain as a token, depending on what region in the world you are, that's a digital asset, or it's an equity, or it's, you know, however it's governed in that region. But all of the trading can be aggregated into one place. So we're seeing some efficiency there, because right now where the global regulatory environment is a little bit flexible. So there is efficiency there just on that last mile of distribution by having the exact same asset and the same address on chain be represented in its local geographies as needed.
And Alex, I want to add one thing that nobody's talked about, maybe we can explore, right? So for example, Sarahjon, your product is great, okay? So clients are going to love that product. But today, all products that are in the private asset space, which that is, basically you have two choices. You can either invest 0% of your money, not buy it, or you can put 100% equity capital behind it, right? There's literally almost no access to leverage or to financing in the alternative asset space. And the reason is not because the products aren't creditworthy or credit underwritable. Like, you can underwrite the risk on buying that product. It's that the cost of encumbering a huge amount of legal documents, of doing like bespoke work, it's just not worth it. Like, no private bank wants to do that and lend their wealthy clients money to buy that one particular asset. But when you tokenize it, you can realize economies of scale in underwriting. You can encumber in a second in a smart contract or in a box, and you can create, you know, what essentially product market fit. People would love to buy that product with 50% LTV. And that today in paperwork doesn't work, but in tokenization format works great. So I think, to me, the like massive unlock will be things like that in the alternative space.
Yeah, this is where we hopefully come in, but you all have to do your job first. All right, so we've talked about tokenized assets and all these theoretical benefits. The title of the panel is "People Might Still Not Come." So how does go-to-market change between, you know, traditional stocks versus tokenized stocks, for example?
Well, the market between traditional stocks and tokenized stocks isn't too different for us. So it's, right now our value prop in the US isn't there, right? People already have access, especially in other very developed markets. Why would they choose a tokenized form when they already have a brokerage account? It's not there. But we are seeing very active interest in other places that we're going, all over the world, Africa, Pakistan, here in Latin America. So I think the answer is going to vary depending on where you are.
And do you market things as, does the blockchain or the fact that it's tokenized even appear in the language, or is it just a stock as any other stock and you abstract everything away?
Yeah, that's a good question. And most of the time, whether the fact that it's on blockchain and a token isn't even a part of the marketing. It's just come and invest in Tesla, come and invest in Coinbase or whatever you want, or just park your money in SPY or a T-bills fund and let it grow.
Where does fiat come into the game? As in, do you still need people to have a private key to participate?
We support a kind of very wide variety of integration options. So because a lot of our clients are other businesses, they range from fully Web 2, just want a REST API, all the way to they have a whole key structure that they're managing and they're coming to us with self-custody, to the point where they're even bringing their end users to us with their self-custody wallets. And then we are either our partner or us are KYCing that user. We load that into our registry, and then we can serve across all of those different clients. So we do work with some custody providers as well, specifically for the business accounts.
Interesting. What about you, Sarahjon?
We have a multi-pronged approach to our go-to-market strategy. I think we're in a fortunate position in that the product we're bringing is, in my opinion, sort of the highest quality risk-return product that's out there over the cycle. It's short-term, dollar-denominated, commercial real estate loans with very attractive loan-to-values. And the private loan market currently is, you'll have a originator who will, originate and structure a loan, and that loan will be funded by a BDC or like one or two family offices, maybe an insurance company. And then those investors are holding those loans to maturity. So the go-to-market for us is that there are a lot of traditional channels, whether it's family offices that might want to, instead of directly funding the loan for $20 million or participating in that loan directly for $20 million, they're going to be buying tokenized loan participation from us for, as low as $50 or for a few $100,000. So we are truly bringing to our distribution partners we're engaging with, whether you're a family office or an on-chain pool of capital, or a wealth management platform in Brazil that wants to buy these and give these interests to their clients, either in tokenized form or just through showing in their app that you now have access to this type of product. We do benefit from the fact that very few people have access to this product at all today, and we are trying to leverage existing channels to meet clients where they are now in their wealth management journey. We will definitely be partnering with places like TomNext that are solving problems for the wealth management space in general, and are moving forward digitization of broad types of alternative assets. And then we are going to have a direct-to-consumer app, but realistically, if you have a $100 million loan, you do have to find existing channels. You can't just throw that up on your new app and hope that people find you. So we're doing sort of a multi-pronged approach, but I think we are by the day increasingly confident that there will be pools of capital that will want to purchase these. And I think part of what I'm working through is traditional pools of capital. I want to abstract the tokenized part away. We can show them, we can introduce them to a qualified custodian. They don't really have to worry about the tokenized part. We can solve that for them if that's an issue. But we are, through tokenization, providing them access at entry points they would not be able to.
At Onyx, at what point does the fact that it's tokenized come into the picture when you deal with your counterparties?
I guess it's, again, more coming back to what I was saying earlier. It's more of like tokenization as a tool and as a mechanism for one of our clients to solve an immediate pain point that they have. So it's very much like, to the thread that Sarahjon was saying, like meeting clients where they're at, the experiences that a client has when tokenizing an asset and then trading it in our intraday financing application, for instance, is very similar to an existing trading application. There's not a wallet that they need to go out and like connect into. It's like a very, very similar experience to like what they have today across other types of asset classes. And I think even as we start to expand to issuing assets directly onto our platform, not just for the purposes of using them as collateral, but like beyond that, it is around thinking about, how do clients access assets today? It's typically through their custodians or typically through their wealth channels. So how do you like integrate into those ecosystems so it's not that like burdensome lift to like get onto our platform?
Do you imagine the experience to change or to be any different from a traditional Web2, a traditional asset that's not tokenized if you're the client?
I think it really depends on who you are as a client. I'm sure for a lot of people in the audience and at this conference, like, yes, absolutely, the experience would change. But for a lot of the clients that we deal with, there really isn't rationale as to like why they would want that change, or that's not front and center for them. It's more around like what's the immediate value that I can get out of like doing something with JP Morgan or doing something with this particular asset, and then not having to change a process that works for them in order to do whatever that activity might be.
Interesting. Itay, assuming that the asset is tokenized and you're distributing it, so you've run through the distribution of fill out 100 pages of paperwork and subscription docs. How do you imagine educating the clients on the alternative method?
So our hope is that we abstract it all away from them. So if you look at this room, this is not the target client set, sadly, because look around, like the average age, well, what you need to know about the high net worth or wealth space, 95% of the assets are intermediated. Somebody is managing money for someone else. And the average age of that person is 60 years old. So the idea that we're going to convince them about anything in Web3 is nonsense. They don't want to talk about it. When they see our demo, they see connected wallets, they're like, what is this? I don't get this. I don't want this. Right? So we have to abstract literally 100% of it away from the user experience, because probably on this stage, Jake is the only one who knows how equity settlement works. It's completely abstracted from the user experience. So that's like critically important. It just has to be digital. Like that's the point. It has to be a digital app. And the trend that we see is the convergence of the experience of investing in public markets, which for everybody is digital, hopefully. Hopefully nobody has a stockbroker left that's calling them, to the alternative space where it's completely analog. So for us, it has to be 100% abstracted. Blockchain is just enabling the digitization. It's enabling all of these benefits. And so the question is, when you get into it, why are we doing it this way? Because I'm getting some additional benefits. Access, leverage, like I'm saving money in settlement, it's all in one place. All of these benefits are what you actually sell to clients, and that is user experience, right? The infrastructure, they actually don't give a shit.
I agree 100%, and you just listed those benefits very succinctly. The same is true for small value retail, like small order value retail. They don't care that it's blockchain. Again, us here, we understand, we'll talk about tokenization and all this stuff, but the broad, just around the world user base who want to invest in stocks, they want to invest in stocks. That's what they're here to do. So I don't need to show them a tokenized stock. It's just, how can I do that? How can I do it? How can you make it easy for me? And most of our end users don't know that there's a wallet involved at all.
I just want to drill down on the access question. So for foreign access to stocks, that makes sense because you would physically need to move the money to the US and they trade on very limited number of marketplaces. For the case of, I guess I'm here to play devil's advocate just a little bit, and in the case of your wealth manager in London, it's not digitized, but can you not, why do you need it tokenized? Can you not put it in a database? Because that person already has access, they're in the right jurisdictions, they're regulated, they already can click the buttons or go to interactive brokers.
Sure, so our thesis and what we observe is digitization allows for easier access. Like ultimately these are permissioned, right? Alternative assets, private assets are permissioned. If the GP doesn't want to let you invest in it, then you're not investing in it. So the idea is digital formats will reduce the friction to do things like aggregation, which is what we do, because you can put it all on one screen much more easily than me. Like if you think about some of the, what I call the I'm not going to use a really bad word, let's just say early stage people. Like, and they're big companies, iCapital, Case, Moonfair, Yield Street. They like negotiate with every issuer, hand to hand, to say, okay, we'll put this on our platform. They'll write up a really nice thing that for everyone will say, invest in this. They will never say, don't invest in this, right? Because it'll always be like, this is great, this is great, this is great. And then it's curated. So the initial steps of this digitization and alternatives is very curated. And the technology they're using, I like rail against, it's not digital, it's DocuSign. DocuSign is not digital. You can't do any, it just replaces the wet ink. It's still paperwork, right? So for me, I saw this in public markets. I'm probably the oldest person on this stage. So I saw this happen in equities. I saw this happen in FX and in everything. Once you create digital record keeping, it's not that that produces liquidity or produces access in and of itself. It just reduces the friction for the likes of Charles Schwab or Interactive Brokers or Jake to allow a broader access point. And so that's really the point here. It's not the tokenization itself. Tokenization doesn't bring liquidity. It doesn't bring access in and of itself. It just reduces the barrier and the friction for other good companies to go and do that through, satisfying product market fit. And I think one of the mistakes that we make in this community is that we just assume tokenization is this magic formula. It's not a magic formula.
Yeah, I would just want to add on to that because our team has done a lot of digging into the processes around private asset investment through like our wealth channel, and it is wild how much reliance there still is on like literally reconciling like spreadsheet 1 to spreadsheet 2 in this space. That's not to say there isn't like a potential avenue for a centralized system to like solve problems and sort of like bring digitization to alts. I think it's more so the fact that because this space is still quite analog, there is an opportunity to uplift that asset class onto a technology that's more future-proof and fit for innovation like financing, trading, so on and so forth, and building out those utilities in that ecosystem.
I'm going to add one more point that I think is tangential to what Itay was saying, which is that a lot of the sort of fractional alts platforms that exist that are essentially playing a curational role, they're actually trying to find people to put deals up there. They're not even like really negotiating or structuring the deals at all. So arguably there's a negative selection bias, whether it's sites where you're raising capital for startups or sites where you are trying to raise X amount for a fund or for a property development or something. So what we're looking to do is sort of turn that fundraising model on its head, where what really exists now is a lot of really high quality funded deals that somebody has spent $500,000 in legal fees structuring and negotiating, and they've put $100 million of their own money to it. And they're happy to hold that for 24 or 36 months, but if there was an avenue like ProfitR for them to effectively do a new form of syndication where they sell off 25 or 50% of their interest in that loan, that really amplifies their business because they've essentially turned over some of their equity, and they can continue doing their own business, which is originating and structuring deals and putting large amounts of capital to it. I mean, these markets operate this way for a reason, which is it does take trust, it does take a lot of expertise to go in and cross-collateralize and cross-default certain assets within a property, for instance. So we're not going to try to disintermediate that because the best deals do get done that way, but we're trying to come in and provide an avenue for those who are operating in that space to say, look, you can really seamlessly sell off a portion of that loan to people who really want access here, and it'll enable you to grow your business and kind of turn over your equity and de-risk and rebalance as you see fit. So,
I was just going to very briefly add that tokenization allows us all to easily interact with each other, cross-list assets, get up and running, sell into our different client bases without leaving the same system or doing extra engineering work. So I think as we move forward, that'll become increasingly valuable.
That's a good segue into, we've talked about origination, issuance, access. Then let's say the asset is live and has been purchased for the first time. How do you handle, or I guess, what's the plan for secondary liquidity and credit on top of those assets?
My plan for secondary liquidity is to allow people to bet with leverage on stocks, which is a tried and true strategy to bootstrapping a secondary market. So that's coming in January, but yeah.
So will that be some kind of permission DeFi situation?
It'll be 100%, yep. a permissioned exchange that's using DeFi tech under the hood that you can get up and running with. And then we can aggregate, again, and this is something I heard several of you say, which is, you might start with large clients, or in our case, aggregators of other businesses, but that provides a lot of comfort and liquidity for, direct to consumer retail to come in and start trading on top of that and leveraging that liquidity as well.
We're focusing first on making these assets available, but in terms of liquidity, we are having some conversations around with some dedicated pools of capital that would want to underwrite these and effectively enable, or they would put like a standing bid at 90 cents on the dollar, 95 cents on the dollar on any of these loans, so that if you're a tokenized loan holder for a 24-month loan and you want to get out at, 5 months into it or whatever, there will be always a bid at, a small markdown for you to get out. We're also exploring an insurance product. I mean, these assets are exactly what insurance companies want to be holding. So there's an avenue where when you come in to buy a token, you maybe pay a small premium or have the option to pay a small premium if you want to ensure that an insurance company in the background will always be there to purchase that asset from you. We are integrated with Onyx, which is a digital securities ATS, and so all of these loan interests will be issued under US private regs, and we will be able to list them seamlessly. It's already integrated from a tech perspective into this exchange, but we'll be figuring out liquidity as we go. We have a lot of ideas, but first we want to get the assets out there.
Yeah, I think for us, very simply put, tokenization is the first step. The second step to unlocking liquidity is around enabling all of our distribution channels to then access those tokenized assets. I think.
So what does it take to access Onyx today if you're outside of JP Morgan?
If you're out, so you currently have to be a JP Morgan client to access Onyx products, but there is a view that we have around exploring how other sort of like application developers beyond ourselves could deploy onto our network, issue product out to their own clients, but still interact with our ecosystem, and then basically be able to foster more liquidity through that avenue as well.
I'll be the negative person. I guess I have spicy views. Liquidity is bullshit. The reality is these assets have to be distributed primary before we do anything. Number one. Second, alternative assets, which is what I'm talking about, they're permissioned. The GP has to allow liquidity. Most of them don't. I mean, most of us, a bunch of us are CEOs. We don't want people trading our stock in our companies. So these are permission liquidities. So that's another problem you have to overcome, right? And the third thing, and I think this will be the hardest problem, but I'll end on an optimistic note, is that in almost every asset class, liquidity doesn't come from me trading with Alex. I think when I ran very big market making businesses. Liquidity comes from market makers. So when you go on and you buy a share of Tesla, you're never buying it from me as an end user. It's very unlikely. You're buying it from a market maker. So think about what steps have to happen so that somebody's willing to make a market in one of these assets, buy and sell continuously a lot. I think we get there. I think the end point here is liquid alternative assets. That's the dream. It'll change everything about portfolio construction. It'll change everything about asset allocation. It's one of the most profound changes in the next 10 years around how to run a portfolio. But there's lots of steps between here and there in the alternative space. And the start is let's get digitally formatted alts into the hands of people as primary. If we get there, then we possibly can get to the next step where someone will go, I'll make a market. Because today, if you want to sell your LP in a private equity fund, there's 2 buyers, Lexington Partners, a couple of other secondary funds. They're raising money to buy, and they're buying at a 30% discount to NAV. There's a lot that has to happen before that's 1% bid ask and liquid. But again, the first thing that has to happen is digitizing the format.
Well, let me know if they want leverage.
Probably will. I want leverage, so we should talk.
All right, well, I think we're at time, so we'll just keep building and hope that they come eventually. Thanks, everyone.
Thank you.
Thank you.